Welcome to the Global Pulse, a short video series where our experts break down a trending topic in international business and why it matters to you.
My name is Mike Falkender. I'm a professor in the finance department. And today we're going to talk about the announcement that came out of the G20 summit over the weekend. On Saturday, President Biden and the leaders of other top global economies formally endorsed a new global minimum tax of 15%. Before delving into the impact of this announcement, let's review how we got here. In 1986, we engaged in significant tax reform here in the United States. As part of that reform, our corporate income tax rate dropped to 35%, placing us below the average corporate income tax rate among developed nations. That rate remained unchanged for 30 years. Around 2015, our corporate income tax rate became the highest among industrialized nations. Now, you might be asking, how did we become the highest rate in the developed world if we hadn't changed our rate in 30 years? The answer is that the rest of the world lowered their rates. In the 2017 Tax Cuts and Jobs Act, the corporate income tax rate was lowered again to 21%, placing us in the middle of the pack among industrialized nations. That act also created a provision for taxing the global income of America's multinational corporations. The challenge is that the Biden administration would now like to raise corporate income tax rates, but is concerned that it will incentivize multinationals to move abroad. Their objective is to end what they call a race to the bottom on corporate tax rates. Normally, we would think that competition is a good thing, but in this case, the Biden administration is looking to stop countries from using tax rates to lure companies to their shores. Therefore, the deal that the president was touting this weekend was an agreement that other nations would impose at least a 15% corporate income tax rate, thus limiting the tax differential between locating operations abroad and housing them in the United States. Whether or not this will work very much depends on the details, which will take years to further negotiate. One thing I will be watching is what counts as income that is subject to the minimum tax. For instance, what is the deduction for intellectual property? According to some of the research I've published on this topic, much of the income that US multinationals have moved abroad is related to their intellectual property. If such income is exempted, then what we really have is a headline and a photo opportunity, but no real change in tax activity. We therefore will not know until the negotiations get much further along as to whether this will reduce tax competition among nations or whether it will just add complexity. Complexity generally benefits the largest multinationals who know how to navigate international tax law. We also do not know whether this will obtain the congressional approval that changes to tax treaties normally require. This announcement has the potential to be a significant change in the tax environment confronting global corporations. However, it may also just be window dressing.